right about here, started to transition, not a strong uptrend, but started to transition, and then started to really steepen. Okay? The secondary benefit of the wave is being able to notice these nuances, not just the fact that the market's heading higher and probably in an uptrend, but the strength of the uptrend, the transitions within the uptrend. In fact, if the market continues to consolidate up here, we'll see the wave start to turn over. Okay? If it starts to turn over, that'll show me a transition in the strength and possibly a move into distribution or even accumulation. Okay? I also secondarily have a built-in way to now identify pullbacks, because I trust this series of moving averages so much. When prices pull back to it, I feel that I'm looking at a correction. In fact, another ancillary benefit of the wave is you now have a line in the sand to determine when you feel the market has come down and created a correction, and if it continues to come down further, where that point is that you would now call it a reversal. Okay? So those are some of the huge benefits to having this tool on your chart. Moment by moment analysis of what the market cycle is on any time frame. You can see the nuances, the adjustments in that market cycle. You have ready-made support and resistance levels to help you determine what is a correction versus a reversal. Now let me define what the market cycles are with this clock angle methodology. Anything between 12 and 2 o'clock is an uptrend. If the wave is flat, moving sideways, what we call 3 o'clock, that is accumulation. Okay, accumulation does not happen that often in the market. Where the market is active as Forex and active for the entire day, accumulation is not a common scenario. So if you see the market quiet down, you know, obviously something's coming, either an economic report or it's an illiquid or holiday trading session. There's a reason for it, and you should probably find out why, yeah? Okay, 2 to 4 o'clock is distribution. Now distribution, again, is easier to recognize by what it's not than by what it is. And what it's not is, it's neither 12 to 2 o'clock uptrend, it's neither a 4 to 6 o'clock downtrend, it's not flat enough to be an accumulation, and what you're left with then would be distribution. So markets that are not trending, yet not quiet enough to be known as a quiet sideways channel or range, therefore become distribution. And transitional markets are distribution markets. This area right here, coming out of the uptrend, distribution. This area right here, coming out of the downtrend, this was distribution. I don't believe there's any accumulation on this chart. This could be accumulation back here. See the difference? See the range is so much tighter? The wave is flatter, range is tighter, a little bit more reliable in terms of the support, in this case the resistance. If it was both support and resistance, that'd be great, but see how the range is quieter, the wave is flatter, a little smoother, compared to that, where the range is wider, the wave's got a little bit more of a, let's call it lumpy bumpiness to it. A lot of this will be aesthetics. I absolutely agree. So there is, of course, some subjectivity. But if you utilize the look back, and you do this often enough, you will realize how easily and how quickly you will be able to take a look at a chart of any time, any pair, any time frame, and be able to determine if the market is heading in a distribution, accumulation, markup, or markdown. Now, I like to take that further step, and this is just me. The reason I have the grab plug-in is that now, at a glance, I pretty much know if the market's in a neutral stance or in a negative stance based upon the color of the candles. Okay? If I get enough succession of green, I'm going to be looking at a markup. I get enough blue all pushed together, I'm going to have a distribution or accumulation cycle. I have enough green in succession, again, markup. Enough red, mark down. Blue, neutral. So that's either accumulation or distribution. And what this allows me to do is scan across many, many charts very quickly and determine the market cycle at a glance. For me, the color coding helps a lot because I'm looking at a lot of charts very quickly every day, and every little bit helps. I'm not looking at the market in this view of a single chart. In fact, you know, what I'll have is my charts and multiple charts spread across 2, 3, 4 screens. Okay? And when you have that many charts in front of you, mine are much larger than this, by the way. You know, the sizing for our charts and the sizing for our platforms is made for the sizing of our webinar presentation. But these are not the sizes I would use for actual trading. You know, obviously capturing three 20-inch monitors, 4 20-inch monitors is not exactly ideal for our presentations together. But the idea of multiple time frames simultaneously is why I do this, because I want you guys to understand this is not how I triage or scan the market. This is how I do it, looking at multiple time frames of the same pair simultaneously to make assessments about not only the market cycle, but of support and resistance, and also of what the mood is and how it differs across the different time frames. By the way, if you take a look at the mood or the market cycle across the 15, 30, and 60-minute charts, we're either coming out of some sort of markup cycle and moving sideways, or we're essentially in some sort of congestion up here. But then you take a look at it on a 4-hour time frame, very different, right? Very different. This has been in a markdown for about 2 months. And now we're actually starting to rally a little bit, break through some resistance, some key levels. You take a look at the daily chart, all this action that we're seeing is kind of a little bit of a hiccup in an overall downtrend. Okay? I can see the strength of the downtrend very clearly with the grab. It's just red and nothing but. And even when we went blue, this went to neutral. It never went green. I was never in any illusion that on the daily chart we were in anything other than a markdown cycle and maybe a slight transition or correction and then a resumption of. We never went green. Okay? So again, it's just it's for me, and for some of you you'll like it. For some of you it's, you know, it's information that you might find superfluous. That's fine. For me it's very visually helpful when I'm scanning across multiple pairs and multiple time frames. All right, so we have the moving averages in the green, red, and blue on the chart. By the way, once you've done that, and let's say some of you wanted to put that golden mean indicator in there too. The golden mean is simply the 50-period simple and the 200-period simple. And right now there's a lot of discussion of that because of the fact that the 50 simple is crossing the 200 on the daily chart of the dollar index. So for those of you that want to do something like that, you can go ahead and do it. I like to sometimes make it a slightly different look. So what I'll do is I'll make it maybe dotted. That'll work. Okay? So there's the 2 whites make up this concept of the golden mean. For those of you that don't know or haven't heard, again, today was a lot of talk of it because, not golden mean, sorry, golden cross, golden cross. The golden mean is the 618 Fibonacci. So again, the golden cross, the 200 simple moving average, and the 50 simple moving average. And you might have heard that been tossed around before. Don't confuse that with the golden mean, as I just did, which is the 618% Fibonacci.